Listen to me. Don't skim this. Don't assume this is another dramatic thread. Put the phone down for a second, turn the volume up, and stay with me. Because the clock you're not watching is the clock that decides whether your week is normal or historic. It's Sunday evening, January 25th, 2026. Most people are in that soft, sleepy weekend haze. Sports highlights, dinner, a few jokes, a few errands. A few last minutes before Monday shows up like a bill you forgot you owed. The mainstream feed is doing what it always does. Keeping you calm, keeping you entertained, keeping you moving from clip to clip so you never sit still long enough to see the system's seams. But under the surface, something has changed. Not a little, not maybe. The rules changed. And when the rules change, the market doesn't send you a polite notification. It just punishes the people who didn't notice. We are 6 days from a funding deadline that can freeze parts of Washington and, more importantly, blind the financial system's instrument panel. 6 days from a partial government shutdown that doesn't just close a museum gift shop. 6 days from the kind of disruption that creates data fog, widens funding stress, and turns risk management into triage. The hard deadline on the calendar is January 30th. That's the date that matters, because the temporary funding patch that reopened the government after the last shutdown only buys time. It doesn't solve the fight. Congress kept most agencies running on a short-term continuing resolution that expires at the end of this week, and now Washington is back at the same cliff. Pass new funding or parts of the government go dark again. When funding expires, it isn't a single on-off switch for every agency at once, but it doesn't need to be. A partial shutdown is enough. All it takes is one critical lane of the highway to close for traffic to jam across the whole city. And right now, the most explosive lane is Homeland Security. Reporting says the fight is centered on the DHS portion of the funding package, especially money for immigration enforcement, because the political cost of signing that check just skyrocketed. Republicans say the government must be funded and enforcement must continue. Democrats are saying they will not vote for a bill that, in their words, rewards abuses. The Senate math is unforgiving. Even a slim majority can't bulldoze its way through without votes from the other side. So what you're watching isn't a casual disagreement. It's a standoff with a date. This is why risk managers are frozen. They don't care about the shouting. They care about the clock. When a deadline becomes real, the models stop treating it as a headline and start treating it as an operational risk. They start asking, what breaks if we don't get a deal? And what happens if we lose data, staffing, and transparency right when markets are stretched? If you're thinking, we've seen this, they always fix it, I want you to hear how dangerous that sentence is. Because they always fix it only works when the system can afford a scare. This system can't afford a scare. This system is already tired. And here's why this is different from the shutdown stories you think you already understand. In your head, shutdown means parks closed, a few inconveniences, everyone yells on TV, and then some deal appears at the last second because nobody wants the blame. That's what people told themselves in 2018. It's what people told themselves in every mini-crisis that ended with a handshake and a press conference. But this is 2026. The system is more leveraged, confidence is thinner, and the information channels that guide policy have already been damaged by disruption. We just lived through a long, bruising shutdown in late 2025, over 40 days. So we've already seen what happens when the statistical machinery stalls. It wasn't a harmless pause, it was a fracture. For 40-plus days, the federal statistical machine didn't run normally, and the system learned a lesson it didn't want. The numbers you think are guaranteed can disappear. The Bureau of Labor Statistics later spelled out that most CPI operations were suspended during that lapse, with staff recalled only briefly to produce a specific release. That means the surveys that feed the CPI, prices in stores, rents, services, weren't collected in the usual way. Economists and market analysts warn that gaps like that don't just delay a report, they change the texture of the data, because you can't simply rewind time and capture what consumers actually paid weeks ago without distortion. Think about what that does to expectations. If CPI is delayed, every rate bet has to lean harder on guesses. If payrolls are delayed, every recession call becomes louder and sloppier. If the BEA suspends releases during a shutdown, GDP updates and key income and spending reports get pushed back. When the official stream weakens, markets reach for substitutes. Private payroll estimates, credit card trackers, shipping indices, online price scrapes. Those are useful, but they aren't the same. They don't have the same coverage, the same history, the same authority. And when the market is forced to use second-best instruments, the spread between what might be true and what is true widens. That spread is where volatility lives. Now, ask yourself a brutal question. Do you want the most leveraged market in the world, with trillions in derivatives linked to rate expectations, operating on second-best instruments while Congress plays chicken? Because that's the setup on the table, not in some far-off dystopia. This week, you need to understand something brutal. The modern financial system is a machine that eats data, not opinions, not vibes, data. CPI is not just a number on TV. Payrolls are not just a chart. PCE isn't just an academic metric. These are the gauges that set expectations for interest rates. Expectations for rates set bond yields. Bond yields set discount rates. Discount rates set equity valuations. Equity valuations drive wealth effects. Wealth effects drive spending. Spending drives growth. Growth drives jobs. Jobs drive politics. Politics drives budgets. Budgets drive shutdown risk. Do you see the loop? It's all connected. And the loop gets violent when you remove the inputs. Now imagine the government shuts down at the deadline. What happens isn't just some workers go home. What happens is that the data agencies can be forced to suspend operations. The schedules get disrupted, releases can be delayed, some collections pause, some series print with holes, some benchmarks get pushed back. This isn't theoretical, we just watched it. The last long shutdown didn't only delay headlines, it created measurable distortions in inflation readings and left policymakers dealing with uncertainty long after the doors reopened. That is what makes this week so dangerous. The system is going back toward the same cliff while it's still dealing with the bruises from the last fall. Here is the part most people miss. Modern markets are run on data the same way a pilot runs on instruments. It's not poetic, it's mechanical. Algorithms don't feel optimism. They ingest inputs. Systematic funds rebalance based on those inputs. Volatility control strategies mechanically reduce exposure when realized volatility spikes. Risk parity shifts when bond volatility changes. Trend models chase momentum. Option dealers hedge gamma. Passive flows keep buying until they don't, and when they don't, the lack of discretionary buyers can make air pockets form. This is why a week like this can feel like the market has moods when really it has rules. And here's the scary part. The rules can tighten all at once. One ugly headline triggers a volatility spike. The volatility spike forces de-risking. De-risking pushes prices down. Lower prices widen credit spreads. Wider spreads tighten financial conditions. Tight conditions hit funding markets. Funding stress forces more selling. It's not a conspiracy. It's a chain reaction built into the system's design. When people say, the machines took over, that's what they mean. Not robots plotting in secret. Just a world where the biggest flows respond to the same signals at the same time. And when the signals are noisy or missing, they respond by stepping back. And when the biggest flows step back, the market gets thin. When the market gets thin, small shocks become big moves. Now imagine the instrument panel goes black. That is what data fog becomes when a shutdown hits at the wrong time. That is what blackout means to the people who price trillions of dollars of risk every day. When the gauges go dark, you don't get calm. You get defensive behavior, you get wider spreads, you get tighter risk limits, you get desks shrinking exposure, not because they want to, but because they have to. And you can already feel the system getting jumpy. You can see it in how markets react to every scrap of information. You can see it in how quickly narratives flip. You can see it in the way people have stopped trusting that tomorrow will look like yesterday. So picture the Federal Reserve right now. Picture the chair and the committee staring at markets that are already jumpy, with funding conditions that can tighten in an hour, with politics that can shift in a single statement, and with a world that can go from calm to chaotic before lunchtime. Then remove the instruments. What does a central bank do when visibility drops? It does what institutions always do when visibility drops. It prioritizes stability. It goes defensive. It tries to prevent the worst case scenario, because the worst case scenario in a modern financial system isn't inflation ticks higher. The worst case scenario is a funding seizure, a cascade of forced selling, a sudden loss of confidence that turns into a self-feeding liquidity fire. In a cockpit with the gauges dark, the instinct is not to do something elegant. The instinct is to keep the engine from stalling. That's why markets front-run the response. Not because markets are evil, because markets are competitive and competition makes people move early. Smart money doesn't wait for the official announcement. It positions for the incentives. And here's the incentive. If the Fed and the Treasury are forced to operate in fog, they will bias toward keeping the system lubricated. That can show up through liquidity tools, facility changes, collateral policies, balance sheet choices, and subtle plumbing moves that never get a dramatic headline. Call it what you want. Markets call it one thing, more liquidity when people are scared. Now pause and look around. What has been screaming this week? What has been acting like it smells smoke before everyone else? Silver, gold, hard assets. Major market coverage over the last few days noted that COMEX silver finally hit $100 per ounce and pushed into new highs, while gold surged toward a mind-bending $5,000 level. That's not a normal headline. That's a stress headline. When an asset crosses a century mark like $100, it becomes a public signal. It gets screenshotted. It becomes a story. It recruits attention, and in an unstable environment, attention turns into urgency. And no, this isn't just speculators. Part of what makes this move so explosive is that silver is not only a monetary metal, It's an industrial metal. It's used in electronics, solar, medical applications, and manufacturing. That means there is a constant underlying demand that doesn't care about your chart pattern. And when investment demand surges on top of industrial demand, the market can go from tight to frantic. That's how you get the other phenomenon people are whispering about, premiums and availability. In a calm market, you can always find paper exposure. In a stressed market, people start caring about the difference between owning an entry on a screen and owning something that exists outside the system. In a fear week, the phrase counterparty risk stops being academic and starts being personal. Now, do not mistake me. Price alone is not a prophecy. Price can whip around. Price can be manipulated by flows, by positioning, by liquidations. But what matters is not just the level, it's the speed. In the markets, velocity tells you what kind of move you're in. A slow, grinding climb upward is just allocation. A sudden vertical rocket is urgency. And right now, people are staring at how silver is moving and asking a brutal question. Are we just watching a trade, or are we watching a run? Here's a simple way to understand it without needing a fancy terminal. Just measure how long it takes for the price to travel a fixed distance, say $10. When it takes months to move that $10, sellers are present and resistance is thick. When it takes weeks, that resistance is thinning out. When it takes days, resistance is starting to fail. But when it takes hours, you're not in a rally anymore. You're in a regime shift. This is why the psychology around metals becomes so dangerous and so contagious all at once. In normal markets, as the price rises, demand usually cools off. People think, I missed it, and they wait for a pullback. That's rational behavior under stable conditions. But stress markets can completely invert this logic. In stress markets, a rising price becomes confirmation that confidence is slipping. The price doesn't scare people away, it pulls them in. Why? Because they interpret the move as proof that the currency and the institutions behind it are losing their credibility. This creates a powerful feedback loop. The higher the price goes, the louder the signal becomes. And the louder the signal, the more buyers show up. That's why you hear traders say, nothing is overbought until the panic is over. It's not just a catchy line, it's a description of how human behavior changes when trust starts to thin. Now, let's talk about why that trust is thinning, because this isn't just some budget disagreement inside a marble building in Washington. This time, the political fight is welded to something deeply emotional, something that makes meeting in the middle a much harder sell. Over the last few days, Minneapolis has become the center of a fast-moving national controversy. Reports and widely shared video clips are describing a serious incident involving federal personnel and a civilian. This has been followed by competing explanations and an intense public reaction. In this kind of environment, the facts might take time to settle, but public sentiment settles instantly. People don't wait for a final report to form a conclusion. They react to what they believe they saw, and that reaction itself becomes its own force. And this isn't just one isolated moment. The broader context was already tense, with earlier confrontations and disputes over enforcement drawing scrutiny and demonstrations. Whether every detail is eventually confirmed, corrected, or debated later doesn't matter as much as the immediate perception. For millions of people, that perception is already set. Federal activity on domestic streets is escalating, accountability feels unclear, and the temperature is rising. That perception is politically explosive. Now let's translate that back to Washington. Lawmakers aren't treating this as a sleepy budget exercise. Some are tying their votes to demanding more oversight, guardrails, and clearer accountability. Others are prioritizing the continuity of government operations, insisting that funding must move forward as is, but the rules and the math in the Senate still require cooperation across party lines to clear procedural hurdles. And that's how you turn a negotiation into a collision. Because now compromise isn't framed as being pragmatic. It's framed as giving the other side a win. If one bloc votes for a funding package while public anger is peaking, they risk being portrayed as dismissive. If another bloc votes to change or limit parts of the package, they risk being seen as undermining law enforcement or stability. The lanes for compromise narrow. The political incentives harden. The room for an easy last-minute patch just shrinks. And when politics becomes driven by optics and emotion, the odds of a clean deal drop fast. This is where the financial story and the social story collide. Because if lawmakers don't get a funding deal done by January 30th, operations across government agencies could be disrupted again. This includes the statistical workflows that the markets rely on. This matters because we have recent documented examples of how government shutdowns disrupt data collection schedules and measurement continuity. These disruptions can ripple through economic forecasting and market expectations. So yes, shutdowns are political theater. But in this moment, they're also informational blackouts. They threaten the steady flow of trusted numbers that our entire system uses to price almost everything. Now let's go into the engine room, because this is the part that separates people who just watch charts from people who understand why those charts move. The stock market, the AI boom, the everything rally, all of it depends on leverage and funding. Even if you aren't personally using margin, the system all around you is. Hedge funds borrow, dealers borrow, market makers borrow. The entire plumbing that keeps spreads tight and trading smooth is built on overnight financing. And that's where a rate called SOFR comes in. SOFR is the secured overnight financing rate. It's the cost to borrow cash overnight against treasury collateral. Think of it as the heartbeat of the secured funding market. It's one of the cleanest snapshots we have of what money really costs right now. Then there's the rate the Fed pays on reserve balances, known as IORB. This is an administered rate paid to banks for holding their reserves at the Fed. In a stable system, the Fed's administered rates and the private secured funding rates don't drift too far apart. They move in the same neighborhood. But when they start to diverge, when private funding like SOFR gets more expensive relative to the Fed's rate, it's a signal. Not a meme, not a slogan, a real signal. It can mean that the demand for cash is rising faster than the official framework implies. It can mean counterparties are becoming more selective about who they lend to, or that liquidity is tightening in places that won't show up in a headline until it has already moved the markets. It tells you there's stress building under the surface. So when you see the price of an asset like silver moving with incredible velocity, it's not happening in a vacuum. It's connected to the erosion of trust you see on the streets, the political gridlock in Washington, and the subtle but critical stress signals flashing in the deepest parts of our financial plumbing. All these things are intertwined, feeding into each other in a cycle that's becoming harder and harder to ignore. This is the big picture, and it's what really matters right now. Here's how it works in real life. A fund is long a basket of equities. Maybe it's long tech. Maybe it's long the broad index. It finances part of this position overnight. As long as funding stays cheap and stable, the position is manageable. But if the cost of funding spikes, or if lenders tighten haircuts, the math changes fast. The fund has to post more collateral, the fund has to shrink exposure, the fund has to sell. That's how liquidity events happen. Stocks don't crash because everyone suddenly hates companies. Stocks crash because the system runs out of cheap oxygen. The room gets smaller, the margin clerk taps you on the shoulder, and selling becomes mandatory, not optional. Now imagine this happens while politics is generating uncertainty, while a shutdown deadline is approaching, while social unrest is spreading, while economic data reliability is already in question. That is how you get the perfect storm. Uncertainty plus funding stress plus fragile confidence. And in that storm, the people start asking, what has counterparty risk? What depends on someone else keeping a promise? What depends on the system staying calm? Because in a funding crunch, everything that lives inside the system gets repriced as if the system might not behave normally. That is when neutral assets become attractive. That is when outside the network assets get a bid. This is why you're seeing the precious metals story gain traction at the same time the plumbing story is getting darker. Because in a world where trust is the scarce resource, the assets that require the least trust start to look like shelters. Now, I'm not going to tell you that nothing can go down. In a true liquidity shock, almost everything can get sold for cash in the first wave. That's the nasty truth. Even gold can dip in an early dash for dollars. Even silver can whip violently because it's smaller and more volatile. But here's the key. What happens after the first wave depends on whether the market believes the response will be tighten or stabilize. And in shutdown-driven fog, the bias is stabilizing. The incentives are to prevent a freeze. The incentives are to keep the pipes flowing. The incentives are to avoid a cascade, while the data is unreliable and the politics are hostile. So when people say the market is front-running, that's not a slogan. It's literally what markets do. They price expected future conditions. Now let's talk about Monday. Monday is when the weekend pressure releases into open markets. And when a market has been closed while headlines and emotions stack up, Monday mornings can be violent. Not because the world ends at 9:30 a.m., but because the first flows set the tone. Asia opens first, Europe reacts. Then New York comes online and the largest liquidity pool meets the largest narrative shock. If you're watching metals, you watch the Sunday night open and the early Asia flow. If you're watching the shutdown risk, like a professional, you also watch the shortest end of the treasury market. Bills that mature right around the deadline can trade with a weird edge as investors decide what they want to hold through uncertainty. You watch bank stocks and broker-dealers because they're sensitive to funding conditions. You watch the VIX, not because it's magic, but because it's a thermostat. When it jumps, it forces mechanical selling and strategies that target volatility. You also watch language, not opinions, language. Does leadership talk like they're close to a deal or like they're preparing the public for pain? Do they talk about splitting the bill or do they talk about holding the line? Do they schedule votes or do they schedule blame? Because in Washington, schedules reveal intent. And right now, the schedule is screaming urgency. And as this plays out, remember this. Markets don't need the shutdown to happen to move. Markets move on probabilities. The week becomes a countdown trade. Each day without a deal increases the odds, and those odds get translated into pricing. That's why Monday can be violent even if nothing official happens on Monday. And you watch for one specific behavior, the head fake. In tense markets, it's common to see a sharp move in the opposite direction of the dominant narrative, a sudden smash down in a hot asset, a sudden pop in equities, a move that triggers stops, forces weak hands out, and harvests liquidity. Sometimes it's intentional. Sometimes it's automatic. Either way, it's a feature of fragile markets, not a sign that the crisis is over. So if you see a violent dip, ask the right question. Did the underlying conditions improve, or did the tape just shake out the impatient? Because the real driver this week isn't a chart pattern, it's a deadline. January 30th is the cliff. It's the moment funding lapses again if nothing passes. And the reporting right now says the DHS funding fight and the political outrage around federal shootings are making that compromise harder, not easier. That's not noise. That's a structural bottleneck. Here's the scenario map you should hold in your mind. If lawmakers split the controversial piece and pass the rest, the shutdown risk can shrink and markets can breathe for a moment. If lawmakers refuse to split it and both sides dig in, the risk rises day by day as the deadline approaches. If the protests remain intense and the videos keep circulating, compromise becomes politically poisonous. If funding rates show stress at the same time, the market can go from anxious to panicked quickly. And when panic hits, the question becomes simple. Where does capital run? It runs toward liquidity first. It runs toward safety second. It runs toward neutrality third. That's why you can see weird cross currents. Dollars bid for a moment during liquidations, then hard assets bid when people realize the solution to chaos is usually more money and more backstops. This is the point where I need to be brutally honest with you about how narratives work. In a week like this, everyone will try to sell you certainty. One side will tell you the shutdown won't happen because it never happens. Another side will tell you the shutdown is guaranteed and everything will collapse. Both will speak with confidence because confidence goes viral. But the truth is in the incentives and the mechanics. The incentives right now are pushing politicians toward a standoff. The mechanics right now are pushing markets toward defensive positioning. The recent history right now shows shutdowns can disrupt and distort the data that guides policy. And the market behavior right now shows hard asset hedges are in demand, with silver and gold hitting historic markers. So what is the smart way to think about the next 6 days? Think in probabilities, not prophecies. Think in scenarios, not slogans. Think in stress points, funding, data flow, political resolve, and the public's emotional temperature. If lawmakers blink and patch funding, volatility can cool. If lawmakers don't blink and funding lapses, data disruptions and institutional fog become real again. If protests spread and tensions escalate, compromise becomes even more expensive. If funding stress shows up in short-term markets, leverage gets squeezed. And if leverage gets squeezed, you can get forced selling in risk assets and sharp moves everywhere. This is why you don't just watch the S&P, you watch the plumbing. You watch the calendar. You watch the language coming out of Senate leadership. You watch whether the DHS bill gets split from the broader package, because that is one of the paths people are discussing to avoid a shutdown while fighting over the most controversial piece. And while all that happens, you watch the assets that act as emotional thermometers. When people feel calm, they chase growth. When people feel uncertain, they pay for insurance. When people feel the system might not function normally, they scramble for neutrality. That's the real story behind a metal chart going vertical. It's not magic, it's psychology meeting mechanics. Now let me give you the final frame that ties it together, because you need a sentence you can remember when the screen starts flashing. A shutdown isn't just a closure. In a fragile system, it's an information shock. And an information shock is a volatility shock. And a volatility shock in a leveraged system becomes a liquidity shock. That's the chain reaction. Closure, fog, volatility, liquidity stress. And this is where the Fed's dilemma becomes everyone's dilemma. If inflation is still hot but the data stream is damaged, tightening policy risks slamming the brakes in the dark. If growth is weakening but the data stream is damaged, easing policy risks, lighting an inflation fire you can't measure in real time. So the most likely posture in fog is not heroic precision. It's cautious restraint on rates, paired with an aggressive willingness to keep funding markets calm. That's why you'll hear more talk about maintaining functioning markets and ensuring ample reserves than about bold new rate paths. And traders don't need an official announcement to trade that posture. They trade the expectation because the expectation is the edge. That's also why this week can feel backwards. Stocks can drop on fear while metals rise on the same fear because the fear is about trust, not about earnings. The market isn't just pricing profits. It's pricing the reliability of the system that prices profits. You don't have to believe every rumor on social media to understand that chain. You just have to respect what happens when the system loses clarity at the same time it loses trust. So here are your marching orders for the week, and I'm saying this as plainly as possible. Don't let the viral clip hijack your brain. Verify what can be verified, follow the actual deadline, watch the actual votes, watch the actual funding rates, watch the actual data calendars. When someone tells you a story that makes your heart race, slow down and ask, what's the mechanism that connects this to markets? Because the people who get destroyed are not the people who lack information. They're the people who lack a process. And if you do one thing tonight before sleep, do this. Remind yourself that Monday is not the end of the story. Monday is the start of the week where the countdown becomes real. 6 days. That's not a vibe. That's a schedule.